Now we are here to continue our understanding about technical analysis. So before we dive further into technical analysis, we should have a broader understanding about how things actually works in market. It helps us to make better decisions regarding when to apply what. In this session, we will discuss about market making, market makers, and a few ideas surrounding it. Let's start with the market maker. On technical say, market maker refers to a firm or an individual that engages in two-sided markets of a given security. It means that it provides bids and asks in tandem with the market size of each security. A market maker seeks to profit off the difference in bid ask spread and provides liquidity to the financial market. So, in most simple terms, they act as buyers as well as the sellers at the same time, and they make tiny profit from the spread that exists in the market, but they do it in large volume, turning out these tiny profits into bigger sums. Now let's look at an example of market making. Let's say there is a company called K, and the market maker gives a two-way code for this company, which is 10, 10.25, then 100 and 200. This means they are ready to buy 100 shares at 10 rupees and they are ready to sell 200 shares at 10.25. The offer to buy is known in the market as bid. The offer to sell is known as the ask. In this scenario, the spread is 10.25 minus 10, which comes to 0.25, which also can be expressed as ask price minus bid price equal to spread. Now, to the investor or trader, they will be on either the ask side or the bid side. On an immediate basis, this means one who must buy can buy only at 10.25 and one who want to sell can only sell at 10. This way, they are taking away the liquidity in the market, one which the market maker provided. Once that liquidity is gone, the market maker will come up with a new code to continue the liquidity in the market. But for providing this liquidity, he is getting a profit, which is the spread he created. Though 0.25 looks pretty small, he makes large profits on a daily basis since they deal in large volume. Now let's look at the purpose of market maker in financial market, which is to keep the market functioning by infusing liquidity. They do this by ensuring that volume of the trades is large enough such that trades can be executed without much fuss. In the absence of market makers, an investor who wants to sell their securities will not be able to unwind their positions. It is because the market doesn't always have readily available buyers. In that sense, market maker act as a wholesaler in financial markets. The price set by market maker is often a reflection of demand and supply. This also doesn't mean that they are not price sensitive. They are also price sensitive. In most cases, they are willing to buy or sell, but they may be inclined to step away from the market when there is extreme volatility. Now let's come to the market takers. They are less concerned with executing at the best price or the best offer. Instead, they seek liquidity and immediacy, which is enhanced by the constant availability of tight bid-ask spread created by the market maker. The relationship between market makers and market takers is symbiotic, they say. Each needs the other one to survive. Now let's look at the difference between market makers and market takers. Now, when it comes to market makers, they offer prices to buy and sell. and they are mostly arbitrageurs. They make profit from buying and selling, not from the asset itself. And they are very short term in their views, and they make the profit on spread. Spread means the difference between buy price and sell price. You have to see them as wholesalers. That be more easier. When it comes to market takers, they either buys or sells. They don't do both things at the same time. This includes traders, investors, institutional investors, and they tend to make profits from dividend, capital gain, and they may use the position for hedging. And compared to market makers, they are always long term. Now, concluding, the market maker gets paid a premium. Sometimes it's called market maker's edge. Why they get paid? They get paid because they provide constant liquidity. Market makers usually don't care whether they are long or short. Their goal is to always be positioned in the market, because every moment they are trading with an edge that can be lead to a potential profit with a relatively low risk. They are often not tied to a single market, which means they may be operating simultaneously in two markets. That's why they are called arbitrages as well. And now, when it comes to market takers, they need liquidity and immediacy. They want the transaction to happen now. For them, they want good reasonable price to exist in the market always, whenever he want to enter a trade or close an existing position. So if we want to liquidate immediately, we have to either wait for the price we hope to get or be satisfied with the offer coming from the market maker, thereby naturally paying him the edge in return for his service. Position turnover is very high for the market taker. That means the transaction happens heavily for him. 1 second they may be selling and another second they be buying. But for the market taker, the process is always a little calmer. Usually there is a big time gap between his position change, like from the buy to sell and sell to buy. There are traders sometimes trade like market makers, but the real one, like real market makers, are really big in their operation. So we can easily find the difference between the two, like a retail trader and a market maker. And finally, the market makers are also not gods. The exchange may allow more than one market maker in a single asset. This would mean a spread battle between the market makers, which in turn will reduce the spread and increase liquidity. Now, how all this matter for technical analysis? You should not try to analyze a two-way quote market when it is completely a market maker's market, which simply means if you don't find enough volume, liquidity, and volatility, do not trust indications shown by the technical analysis, as they would only lead to bad decisions and bad places. Technical analysis works best when the spreads are tighter and the role of the market maker is limited and asset is very liquid and volatile.